All right, today we are diving into a pretty serious warning from one of the world's top economic watchdogs. Let's get right into it. So right now, if you look at the markets, everything seems amazing. Seriously, stocks are hitting all-time highs, there's this incredible energy around artificial intelligence, and most people seem to think we're heading for a perfect, easy landing for the economy. The vibe is just really optimistic. But, and this is the big question, while all that celebration is happening, the International Monetary Fund, the IMF, is putting out this really stark warning. They're seeing something dangerous building up just beneath the surface. And that disconnect, that gap between the party on Wall Street and the IMF's caution is exactly what we're going to unpack. Okay, so the first thing we really need to get our heads around is the environment we're in. The IMF doesn't see it as stable at all. They're calling it a deceptive calm.
You know, this quote just nails it. The confidence we're all feeling, it's not built on a rock-solid foundation. It's built on complacency. It's that eerie quiet you get before a big storm. And honestly, that feeling that everything's fine has become one of the biggest risks in the entire system.
So, what is the IMF actually warning about? They're not just vaguely saying, hey, be careful. No, they're using very specific, very intentional language to describe the threat they see coming. And this is the phrase you need to know, a disorderly correction. Look, this is not your normal everyday market dip. This is a full-blow, cascading event. We're talking panic selling, we're talking volatility just shooting through the roof, and we're talking about a situation where you literally can't sell your assets because there's nobody left to buy them. That's a liquidity freeze. It's the kind of thing that could put the whole financial system under serious stress.
And that difference is just crucial to understand. A normal correction, a 10 or 20% drop, that can actually be healthy. It's like the market taking a breath. A disorderly correction, on the other hand, is a nasty chain reaction. It's fueled by pure panic. It freezes up the financial plumbing and has this terrible potential to spread like a virus.
So you're probably asking, what on earth could cause something that severe? Well, the IMF has laid out what they call the architecture of risk.
And this really gets to the heart of their argument. The danger here isn't one single thing. It's how a few different problems are starting to connect and feed off each other. They create this volatility amplifier, where a small crack in one spot can get magnified and cause the whole wall to come down. The IMF's report basically points to three of these interconnected fault lines that are building up all this pressure. First, sky-high valuations. Second, the huge rise of non-bank finance. And third, some real shakiness in the government bond market. So let's break each of those down.
First up, asset prices. To put it bluntly, stuff is just really expensive right now. The report says risk asset prices are well above fundamentals. This is especially true in tech, where all the excitement over just a handful of AI stocks has created this massive concentration. And that's dangerous. It's like a single point of failure. If that AI story starts to disappoint, the drop could be fast and brutal.
Okay, the second risk might be the most important, and the one nobody's really talking about. It's the massive, and I mean massive, and mostly unregulated world of what they call non-bank financial intermediaries, or NBFIs. Just think of things like private credit funds, hedge funds. You've probably heard it called the shadow banking sector. And the scale here is, well, it's absolutely staggering. This shadow banking sector now holds about half of all financial assets on the entire planet. Let that sink in. Half. And yet, these places operate with way less transparency, they don't have to hold as much capital, and they often use a ton more leverage than the traditional banks that we all regulate. And this is where the real danger is. They're all connected. The IMF points out that the big, regulated banks that we rely on have huge credit lines out to these NBFIs. So if a crisis hits that less regulated space, maybe triggered by that stock market drop we just talked about, it could send shockwaves straight into the core banking system. It is a massive systemic risk that's basically hiding in plain sight. And finally, the third risk is in the very foundation of the whole system: government bonds. The safest asset on the planet. Well, with government deficits soaring, that market is getting more and more fragile. A sudden spike in bond yields could blow a hole in the balance sheets of banks and funds everywhere. And that would destabilize everything else.
Okay, so that's the risk architecture. It's a lot, I know. But what does it actually mean for you? Well, the IMF's warning isn't just some academic paper. It's a direct mandate for how we should all be thinking about our portfolios in this kind of environment.
the source material really lays out a clear, three-step game plan to get ready for this potential disorder. And it's all about shifting your focus from just chasing the highest returns to making sure you're resilient.
Step 1, do a true diversification audit. This is way more than just owning some stocks and some bonds. You have to really dig in and see how much exposure you have to those opaque private funds in that shadow banking sector. Because when things get messy, simplicity and transparency are your best friends. Step 2, start thinking about cash differently. You know how people say cash is a drag on your portfolio? In a world where everything is this expensive, that's not true. Cash isn't a drag, it's dry powder. Holding more cash means you can be a buyer when a disorderly market forces everyone else to sell their best assets for cheap. You get to act while they're panicking.
And number 3, make capital preservation your top priority. What does that mean? It means focusing on companies with fortress balance sheets. We're talking about businesses with steady, recession-proof cash flows and, this is the most important part, very little debt. In a chaotic market, a predictable, boring business is worth so much more than a speculative growth story.
So, when you put it all together, how should we think about this? The key is to reframe this warning from the IMF. It's not just a scary threat, it's an incredibly valuable piece of intelligence. I think this quote just says it all. The calm we see on the surface of the market right now, it's an illusion. The hidden forces that could cause a really amplified, disorderly decline are already in place. The investors who get that, who can see past this deceptive calm, are going to be the ones who are prepared.
And that really leads to the final question you have to ask yourself. This isn't about predicting the exact day a correction will happen. It's about being prepared for what it might look like. If you understand these risks, you can position yourself to not only survive the next shock, but to actually thrive because of the opportunities it creates. And really, that choice is yours.